Hello, this is Don Anders, and welcome to Easy Money. Today, I'm very excited to welcome Heather Schreiber. We're going to be doing a series of videos on Social Security. Heather is a Social Security expert. This is what she focuses on. This is what she spends a lot of her time doing, but she's a little different. Heather consults for financial advisors, not for clients. So financial advisors who are kind of already I wouldn't say experts, but very well versed in Social Security will hire Heather to come in and give them even more advanced plannings and topics and strategies. So I wanted to invite Heather in and have her give you some tips on Social Security, claiming strategies, things like that, mistakes, and just kind of go from there. So first of all, thank you so much, Heather. I appreciate it.
Pleasure to be here.
Yeah, so the first video we're going to do today, and then you can always click up here for the playlist, but the first video we're going to do today is called the 3 most common mistakes that people make. When filing for Social Security?
Exactly.
Okay. So let's go kind of backwards in order. So could you give me the number 3 mistake that most people make?
Yeah, I would say that people thinking automatically that retirement date and claiming date are one and the same. That isn't necessarily the case, but naturally we tend to think, well, I'm going to retire, therefore I claim. And that happens often without knowing all of the sort of ripple effects of that. And so I think working with someone who can help you navigate that transition from that date that you're finally getting to retirement and whether or not claiming benefits at that stage is the right thing to you is really important. For example, if you're fortunate enough to be able to retire at 62, then does it make sense for you to file right then? Or perhaps should you consider waiting a little bit longer? Perhaps you're the higher wage earner. And so I think decoupling the retirement date from the claiming date is important for a lot of people. And I think that that's a mistake that generally tends to be made because it just seems like a natural progression.
Of course, right. I'm retired. I'm not working, so might as well claim Social Security. I'm not going to get a tax penalty for it, so why don't I claim it now?
Exactly.
And that's what a lot of people do. And you just have to take a look at that because, Heather, like you said, if you are the main wage earner, and let's say your Social Security is $2,000 a month, and something happens to you, well, your spouse is only going to inherit yours and they're going to lose out on theirs.
Exactly.
So having that increase could be really important, especially if your spouse is younger or if you're a male and your spouse is a female, and females usually live longer. So those are all things that I agree. It's really important to take into consideration, not just I'm retired, so I'm going to just go ahead and take it no matter what.
Right. Now, and some people obviously don't have a choice. That is what they need to do. But certainly if you're in a position where you've saved other sources of assets that you have earmarked for retirement, then that's where the discussion needs to come in and say, okay, is this the best choice to claim now? Or is it better to perhaps wait a little bit longer and maybe bridge income from some other source of income? So it's just important to really think about that before hitting the Social Security on button.
I think that's great. So how about number 2? What's the second most common mistake?
So it's kind of a related, as we were talking about you mentioned the survivor benefits, particularly if you're the higher wage earner. What I see a lot, and it's a common question, what's my break even? Everyone wants to know, we don't have a crystal ball. I think that's probably a good thing. But, we'd have to know exactly how long we're going to live to determine what mathematically makes sense as far as claiming, when we're going to get the most out of Social Security. The problem with relying too heavily on a break-even sort of analysis. So, people say, what is the break-even? Well, if you're single, if you live to about 78, then it would make more sense for you to wait till full retirement age versus filing at 62. If you're single and you live to at least 81 or 82, then it makes more sense to wait until age 70, and that's because the benefit increases. The challenge becomes when you think of that way when you're married. And the reason is, and we've mentioned it, if there is a disparity in income benefits, for example, one spouse has a $3,000 benefit and another spouse was in and out of the workforce or whatever the case may be and has half of that, then what that higher wage earner does is going to affect the survivor income of the other person. So you can't really look at break evens without looking at the combined longevity of the couple. And the reality is that there is a 1 in 4 chance that one of them is going to live to like 95 these days. I mean, life expectancy is continuing to increase. I mean, the break even to wait until 70, if we're talking about a single person, is about 82 years old. Well, the average life expectancy of a healthy 65-year-old is 83. So
Yep.
you can see how you really need to think about both spouses, particularly when you're dealing with a disparity in income benefits, and how that higher wage earner's claim age is going to ultimately affect the surviving spouse of the two, because we lose obviously the lower benefit and we retain the higher one.
And for the younger people who are watching this, they can also, if you're in your 50s, 40s, 50s, you want to file early and you're worried about whether or not it affects it, you could also start planning with life insurance and things like that as well, correct?
Absolutely. Time is on your side if you're younger. I say the sooner that you can start planning for Social Security, to not rely on it for as much as, it's intended to replace about 40% of pre-retirement earnings. The reality is, for a lot of people, it's 50 to as much as 90% for a lot of folks. So I think those that are younger, that have more time to plan, not only, to save more, but to tax efficiently save more, should really do that, so that they're really not relying so much on Social Security for their post-retirement income.
I love it. All right. So what's the number one most common mistake?
So I'd say the most common mistake, and the things that I hear confusion about is, how is my benefit calculated? It is incredibly important that you understand that, because it is obviously, it's the crux of what you're going to receive in retirement. And so I won't go into the gory details, because it can get very technical, but basically your benefit is based upon your highest 35 years of indexed earnings, meaning that all the earnings before age 60 are indexed. So that means that your earnings in 1977 might look piddly to us today, but if they're indexed to today's dollars, they'll look more in line with today's dollars.
Okay.
The importance of that is because if you have less than 35 years of earnings from which to calculate what's called your primary insurance amount, then Social Security doesn't say, oh, you only have 20, we'll just base it on 20. No, they still base it on 35. So that means you have 15 years of zeros in that calculation. So people always ask, well, does working longer help? I would say absolutely. So the folks that have worked their whole careers, have 35 years of earnings, every year that they have additional earnings, the Social Security Administration will recalculate their primary insurance amount to make sure that most recent year of earnings doesn't identify as one of the highest 35. So it could increase their benefit. But the folks that have been in and out of the workforce, or perhaps stayed home to raise a family and are now entering the workforce after being out for a long time, those are the folks that really need to understand that the more zeros that you can replace with 35 years of earnings, the better your eventual benefit's going to be. So that is a critical thing. I hear a lot, people get confused with pensions. They say, is it your highest 30 last five? I did a seminar last night, and they were asking, is it your last five or your worst five? What is it? It gets confused a lot. You just need to know it's the highest 35 years of indexed earnings. Even if you're taking a benefit and you continue to work, you could see an increase in your benefit because of that most recent year of work. So really important to understand how that benefit is, what it's based upon.
So kind of to make it easy to understand, if you don't have 35 years of work experience because you're in and out or whatever else, it will definitely help. It'll be a big difference.
Absolutely.
If you do have 35 years, it'll help, just not as much, correct?
Yeah, I mean, it probably will have a negligible effect compared to the person that's actually replacing a zero with earnings.
So if somebody's thinking, well, I'm earning a lot more now than I did back in 1970, so I'm replacing that. That's not necessarily true, because it's indexed. So it's going to be kind of probably not that big of an impact on their Social Security going forward, because that's a pretty common question that we get is, okay, well, should I, how much is my Social Security going to increase if I work another few years? And really the answer is, depends on whether or not you've already completed your 35 years of service,
Yes.
correct?
Yeah, and there are calculators. If someone goes on to My Social Security, and incidentally, everyone should have a My Social Security account, there are calculators that you can use to do hypothetical scenarios of retiring early, changing your earnings, how that will affect your eventual benefit. So use those. Social Security's website is actually quite good. You can type in benefit calculators in the search engine, and the online calculator is the one that you can actually go in and plug in all your historical earnings and then do what if scenarios. Now, if you have a My Social Security account, it automatically populates your prior earnings. So that's why it's good to have one. But definitely explore that because, like you're right. If 1970 income obviously looks a lot different than probably today's income, but it is indexed, so it won't look so dramatically different. But the reality is our highest earning years are usually the ones right before retirement. So definitely continuing to work can increase your primary insurance amount, and can obviously you spend less time in retirement if you're continuing to work. So all good things.
That's true. Thank you so much, Heather. We'll see you in the next video.
Thank you.
Thank you so much for watching my video. I hope you enjoyed my interview with Heather. If you click here, that is the full playlist with all of the videos that I did with Heather about Social Security. And then if you click here, you can go ahead and subscribe for more content just like this. We focus on retirement planning. We focus on making investments easy. And we're going to be having a whole series all about interviews with experts. So please subscribe and we'll get updates and alerts on that. Also, Heather has a newsletter that if you'd like to subscribe to learn more about Social Security, you can do that. We're going to link that down in the description below. Thank you so much. Have a great day.